بسم الله الرحمن الرحيم، والصلاة والسلام على أشرف الأنبياء والمرسلين سيدنا محمد وعلى آله وصحبه أجمعين. Today نويت التعلم والتعليم والتذكر والتذكير والنفع والانتفاع والحث على التمسك بكتاب الله وسنة رسوله وابتغاء قربه ومرضاته وهداه. صلاة وسلام الحمد لله رب العالمين. In the name of God, and peace be upon our Prophet and his companion. Today I'm gonna to share with you a course which is DCF financial model. By the end of this course, you will find you will have first of all, you need to download this Excel template. Download. After you download, you need to go to Excel, the sheet on Google. By the end of this course, you will have this result. You will have a model like this, and you will be able to build your DCF model, discount cash flow, and you will be able to drive the fair price of the share for a company, its value. So let us start. First of all, you need to upload the model that you already download. So we have the financial statement of BMW. Basically, you need to have 5 years of financial statement to make the DCF model, but ideally 4 years will work now. This is just to show you the dynamic of the discount cash flow. Bear in mind that before you do this, you need to make fundamental research about the company and see the drivers of the company. For example, the project they have, their expansion plans, so you can build the assumption. Let us work step by step so you can understand. I will not cover WACC, which is weighted average cost of capital, because it's a huge topic. We'll cover it in another course, hopefully, inshallah. So let us start. First of all, I have some blue numbers here. I already calculated for you, and I have it. For example, share outstanding in millions. This is from the Google. So let's start. First of all, we bring the revenue of the company. Revenue. So this is the revenue. And this I will try to compose and make it short as possible, while it's a huge topic. I will try to cover the definition as I can going through, but you can ask question. So we do also the total operating expense. So EBIT, which is basically you can bring it from the financial statement, or you can calculate it directly, which is revenue minus expense, total of expense. Tax rate, I already calculated for you, which is the profession, this one, profession divided by net income before tax. I calculated already here. So we need only to bring it, this one. Next, this where the assumption come. As I said before, each financial advisor or investment banking or so whatever, they have their assumption, and to for the model to be reliable, you need to have accurate assumption. But for the sake of learning and showing you the dynamic of DCF, discount cash flow, we'll have a basic assumption. Again, this is not you can't use it as a financial recommendation or advice. So we'll do like this. Basic here, over base year, last year, -1. Correct. Then we'll do the same for the expense, equal 2017 over the year before, -1. So we have the first part of our discount cash flow model, which is the historical of finance for the company. Then we'll do the company. I will highlight this in green. This one I'll highlight it in yellow for you. We need the average for these three, which is basically our assumption. We'll use it as the base for this model. Average. Okay. Over I for we need also these two. We need also this one. We'll take the rate average because we need it. Tax rate. Okay. So next we'll do the 5-year forecast. Okay. For the forecast, it's basically equal this plus the average rate that we will use plus 1. Okay, multiply. sorry, multiply this plus 1. So we have our first here. We do it for the second equal base here, multiply the rate. We will make this plus 1. Okay. So next we'll try for the remaining years. We'll do the same for the total expense equal this multiply by the rate plus 1. I need to put it in. Okay. Plus 1. Next, the rate plus 1, and we need 2, so we can drag the remaining. Where is it? Yes, this one. Okay. So now we have our forecast. If you see, we have the average of expense more than the average of revenue for growth. So the G here is less than the G for expense, which is not, if we did the fundamental analysis for the company, will not be the will not be the result or the assumption, because here we only want to show the dynamic of DCF, not the assumption. This assumption is the basic for showing the dynamic of DCF. Also, we'll do this the same rate, the average. You can copy for the remaining, or you can do like this. Let's see, it's working. So for EBIT, basically it's equal revenue minus expense. So now for depreciation and amortization, net capital expenditure, and change in working capital. So basically, you'll find this in the financial statement. Depreciation. Yes, this one. Basically, we have here 0 for depreciation. But to be the ideal model, we should plus it even if it's 0. Good. Next, we need the net capital expenditure. I will explain the DCF flow cash, financial cash flow formula in a bit, but let's first fill the info. Net capital expenditure. It's we'll find it in the financial statement. See, we have it here in minus. Which is not the case normally. We need the change in working capital. Working capital, it's also here. Expenditure, change in net working capital. Here. Also, it's minus. So we'll also take the average for these. The average equal average. Use the average also for this one. Either you can base it like this, or you can base it one time, or you can also just do this. And drag it to the end. So equal equal. Now next we'll calculate the terminal value. Basically, it's the multiple for German company is 20. You can, if you don't know, you can just search in Google. You write EEB, EBI a bit multiple, and you will have it. So basically, we'll use a bit. This is the formula for this is the formula. Okay. So here we have the formula a bit, tax rate, tax shield, plus depreciation and amortization minus net caps minus increase in working capital. Be careful here. See, it's have minus and it has minus. So basically, minus and minus equal plus. You need to be careful when you need to be careful, because basically what we do here, it's this is accrual accounting system. We bring it back or reverse the action to a cash-based account system. We take the EBIT and then multiply 1 minus tax rate, 1 minus tax rate. This is the tax rate, plus depreciation, because basically we add the depreciation back. It's already positive. Net capital expenditure, okay, it's negative, so we also added minus the change in working capital. Because minus and minus, it's plus. So we put minus and it automatically will be added back. Sorry, this one. It's this one. Basically, we reverse the action from accrual accounting system to cash-based accounting system. I don't like because it's cash, we change it to 2. Okay, so now we have our values. So the terminal value, basically the terminal value is EBIT plus the depreciation and amortization. Depreciation and amortization. Okay. So equal EBIT and before interest tax plus depreciation multiply by the multiple. So we have it here. This is basically your exit value that you need in your discount cash flow model. We write it here, we copy it. Just take it from here. Okay. So basically now you have, I will talk a little bit about WACC, because now we'll calculate. WACC, weighted average cost of capital, or your discount rate, or the required return rate for a company for its debt and equity for investor. This is the rate. I calculated the rate here by WACC, weighted average cost of capital. This rate is actually for example, you have project or so whatever. This is the required return for investors and for the project to be, say, to be profitable. If it's less, you don't go with the project. Uh, Beta, it's the normal beta is around 1. How you calculate it? There's many ways. If you don't know, just search, and you can actually calculate it like covariance of BMW, rates of return. Then it's in uh, it's in DAX index, also DAX returns over the variance of BMW, variance of BMW. So return. This is how you calculate beta. Beta is for example, here we have around 5. So if the index minus drop or increase by 1, it will affect only PMW by half. This is the here you also we have risk-free rate, and we have the equity risk premium. This is you can find it by market risk premium in Germany in 2019 from Stasta. This is the yearly risk-free rate. Risk-free rate. Also, they call WACC they call it the required return premium, which is risk-free rate and minus the market rate. This is the systematic risk. Uh, the cost of debt is easy, but the work on cost of equity, cost of debt, you can just use the bond for BMW. It's easy. Or you can just look at the financial statement, the debt. This is the tax shield. So let's be back to so how we do NBV, which is net present value. What is NBV? NBV is for example, net present value. A dollar today worth more than a dollar tomorrow. This is the basic of NBV. So basically, you just do like NBV. And if you don't know the formula, it's already here, which is the rate, free risk rate, which is WACC, and then the forecasted cash flow, financial cash flow. So we have it here. Okay, then so what you need also, you need the cash and cash equivalent. This is from the financial. You'll find it, cash and cash equivalent. cash and cash equivalent. Cash and cash equivalent. We use the last year. Then we have the debt. The debt you have total debt used last year, but also we need total long-term debt. Total plus notes and the current portion of debt. Then you will have the equity value, which is basically this plus this minus the debt. I already have I searched before I did search the outstanding shares, which is in millions. You see all in millions. If you see everything in millions. So basically you need to divide this by this. So you have the fair value price, it's around 16. This is the market price as of 13, which is, see, the fair price is 60. So if we so basically with completion, we do a recommendation of so this is not an financial investment advice. This is only to show you the basic dynamic of DCV. If you would like, I can do other models or whatever topics you have. If I forget something, you can tell me so I can explain more in depth. So this is we discounted to the present value, the cash flow. So basically you have a recommendation to sell. This is the WACC. I already told you how to calculate the tax shield, tax rate. Basically, this is what is WACC. WACC is the there's hold foreign visitors, the minimum required return for foreign visitors, the threshold hold. I hope you find this helpful, and if you recommend any other topic I can tell you about. Now, if you hear many firms invest in financial AI models, already template models, big firm invest in that. They want to make an AI for a financial organization to help them improve. It can be done easily, but it need a time, dedicated time, and structured plan to develop these AI model, and it would be helpful. And always we say number 1 + 1 equal 2. There's no other value than 2. 1 + 1 is 2. So if you have the correct number, you will have the correct output. But you need to know how to build the assumption. As I said, uh, it depends on your fundamental analysis for the company before you doing the DCF. You look for its expanding plan and so on. Thank you, and I hope this was helpful.